Okay, welcome back. In this video we're going to be talking about a few indicators. We're going to be talking about the stochastic oscillator and Bollinger Bands and our 200 period simple and exponential moving averages. So, a few things about the oscillator. I think in the last video we went through how to set that one up. So, on your navigator panel, which you can get from here, open it up and you'll find it in each section: indicators, oscillators and stochastic oscillator. Drag it onto the chart of choice, and K period you're going to set to 5, slowing 7, D period 3, close, simple, and we went through the colours. I have mine blue and red, nice and thick. Levels, very important, set to 20 and 80. Okay, so this one's on the chart already. I'll open this one up. Now, the stochastic oscillator is used to identify extreme conditions such as overbought and oversold. These are identified as if the signal line is above the 80 level, which is here, and if it's above this area, then it's in an overbought condition. The signal lines are below the 20 level if it is oversold. We use this not as a signal to trade, but another trick for the checklist to identify highly probable situations of a reversal. We only take short trades when the stochastic is overbought, and we only trade long trades when the stochastic is oversold. Also, we'll look out for positive or negative divergence in a stochastic. This is a very powerful signal for possible reversals and should be traded. But look out for the lessons in divergence in the advanced trading section on the members part of the website. But let's talk about the stochastic a little more. So, if you're not sure how the stochastic works, when the price goes through a buying period, like here, the stochastic will keep going up with the price. Now, if it starts to realise there's a slowdown in the buying momentum, then the two signal lines will cross each other and it will start to turn just as the price turns. So, this area, that's one tick that you should put on your checklist for placing a trade. So whenever we put everything all together, like the Bollinger Bands or the moving averages, candlestick formations and stochastic, it's got to be in place. You can't place a sell price when, a sell trade when the stochastic is halfway down or even down at the sell point. Same vice versa, if you're looking to buy, only buy below the 20 level, never buy when it's up above, especially in the 80 or even mid-range. Okay, so it's got to be overbought to sell and it's got to be oversold to buy. As you can see here, right on the very end, we've gone through a little selling period. You can see the price has just touched down into the 20 level. Now, if we were going to buy on the symbol, which we're not because we're selling, this would be coming to a possible reversal area. As long as these crossed in this area, then it's a definite potential. As long as we put everything together, okay. So simply, that's a stochastic. It's just a gauge, a visual gauge into where the market is at just now. So, Bollinger Bands, we can find these guys yet again in the navigation panel. Indicators, trend, Bollinger Bands. We went through this setup before. Just the parameters for these is a 100 period, 2 standard deviations, apply to close. I have mine a nice blue colour and second thickness. straightforward. Bollinger Bands, they're used to plot possible tops or bottoms of a move. This is sometimes the take profit level, as the risk reward is based on the distance between your entry level and the distance to the Bollinger Band when we're in the relevant trading direction. If you cannot get a 1.5 reward to every one that you risk, you should not trade until a more favourable condition has occurred. You should not take profit on a Bollinger Band when it touches, unless it's a range market, but we'll talk about that later. We use it to work out your risk to reward ratio before placing a trade, and also the trading range with possible reversal areas. So let's talk about that a little bit more. So when I'm placing a trade, let's go and find, let's just say in this area here, we were looking to go short. Forget about, okay, we'll do this one here because the stochastic is overbought and we're at the moving averages. Let's just say that this was a sell signal. Your risk would be 20 pips, and I come down and measure the distance to the Bollinger Bands, at which point in time it's 101 pips. So that's very favourable, because that's 5 to 1. Okay, 20 pip risks, 100 pips to potential profit. Now in this case the price did come in. Let's find one that might not work so well. We'll just talk about this one. Let's just pretend we had a trade here. Forget about the stochastic. In this case, we would be risking 40 pips, and the distance to the Bollinger Band is 26 pips. Even if this was a setup, this is one trade that you should not go into. Just because your profit and loss ratios are not correct. Let's just find another one for you. For instance, here, yeah, the stochastic did miss out a little bit, but we're just talking about for demonstration purposes. Your risk on this one, 56 pips, and the Bollinger Band is 62 pips away. So yet again, that is not 1.5 times your risk. So that's the benchmark that we're looking for. Now, you don't necessarily take profit on the Bollinger Band contact. It's merely an observation for entering a trade, for you to assess whether the reward is potential enough for you to enter that trade. Okay, but do not take profit on there. We do have a few exit strategies for your trades, but that's not necessarily one of them. We do have another few tactics. We'll talk about that in another video. Okay, but one thing to look out for in Bollinger Band trading is the range. As you can see here, we have a Bollinger Band squeeze where the bands are, they've gone through an expansion phase, and when the price starts consolidating, the bands will shrink in. They'll start, they'll lay flat levels, tops and bottoms like this, and you can draw your trend lines or support and resistance lines on the tops of the candles or the move, and this charts out a range for you to trade. So how do you trade the range? We'll talk about that later, but essentially it's you sell at the top and buy at the bottom. Trade the range up and down. You can see here, if you bought here, take profit up this level, sell again, take profit, buy again. This one probably would have broke even. Buy again, top of the range, sell again. Okay, so very important that you look out for these Bollinger Band squeezes, because if you're a trend trader, which this system is actually developed for, we don't actually make money in this market because it doesn't go up and it doesn't go down. It just goes sideways for, let's see how many hours. um, 250 hours, and that's trading hours. Okay, so it's quite a long period of time. This has just been consolidating, and if you were long or if you were short, you'd be getting frustrated because this trade is going nowhere. So it's a good tactic to learn how to range trade, and we'll learn more about that later. So volatility marks the interest in the market direction and the volume of traders committed to the trade. If there is a range, there is little favour in any direction, and the people are waiting on something to change, like a news event or a range break. A range can be of different magnitudes and found on every time frame. They can carry on for hours on an hourly chart or weeks on a daily chart if nothing changes. Bollinger Bands are one of my favourite indicators, especially in ranging markets. When most traders are caught up in a range and not making any profits, you can learn to trade the range, buying and selling the tops and bottoms confidently and making profits in a sideways market. Usually plot out the top and bottom of the range markets and use in tandem with support and resistance levels. It is very easy to spot and very easy to predict price movements. The Bollinger Band squeeze is the most important key to spotting a range market. When the bands have both become flat, this has identified the top and the bottom of the range due to the loss of volatility in the pricing, which subsequently means lack of interest, and a range market is born until something changes. It is only when the bands start expanding that this marks an increase in volatility and the interest in the market direction, and a new trend is beginning to form. So what usually happens after a Bollinger Band squeeze or lack of volatility? Normally it is followed by increased exponential volatility. So you can see here US dollar Japanese yen on a daily chart. You can see the Bollinger Band squeeze here. You can see it tightening up. It can't contract any less than that. And what happens after a breakout? We'll just plot some lines in here. You can see that it's making a nice triangle. So there's the top and there's the bottom. So we had a little breakout just here. So that was a trend line break, which that's a nice buy signal. If you didn't buy at the bottom of the range here, you would have been very confident when this broke out through this triangle that we drew in. Price went up a little bit to the top of the range, came back down, tested the support on the opposite side of this trend line right here, as you can see by this nice dramatic spike. And then what happens after that? Price breaks out. Once it's officially out of the top Bollinger Band here, it just continues on and on and on. Okay, so with lack of volatility follows exponential volatility, and vice versa. Once you've had a parabolic move like this, just every day the price keeps going up and up and up and up, you've got to expect a period of consolidation after, because people are uncertain about what the market is doing. Can it actually continue on higher, or is it going to crash? So there is a lot of indecision in the market right now on the United States dollar Japanese yen at the time of speaking, and you can see it clearly here. The 20 simple moving average is sideways. Yeah, it kind of goes down a little bit, but the price is just chopping about inside this large triangle, and then once again on the hourly chart there's another triangle forming inside the larger triangle. So throughout all this period, I would fully expect a massive breakout. In which direction, nobody knows. We can always have a guess, but when the price does break out, we do have opportunities to trade those breakouts. Okay, so nobody knows which way it's going to go. If anybody does tell you, they're lying. So Now we're on to the 200 periods simple and exponential moving average. I'll get another currency which has been trading a little bit, trending, sorry. So we use the moving averages on the hourly chart to plot out possible support or resistance levels. Especially in a trending market, the price will usually retrace to a support or resistance level and test the strength of it before bouncing from it or break through. If the price levels have an effect and give a candlestick formation or a trendline break, this is another great potential counter trend reversal, which means the probability of the initial trend continuing is more probable. So if you know you're short all this period, you look for the price to retrace to either moving average. What I'll do is I'll delete the Bollinger Bands just now. I'll delete this. So these are the three moving averages I've got. We talked about the 100 simple moving average. We've got the 200 exponential and the 200 simple moving average there, marked in white. I marked the exponential in red because it means it's extreme. So usually when you have a fast trending market, you can see this is very fast because the price very rarely retraces up to any trend line. But I'm sure if you put a 50 moving average, which we don't trade with, it would bounce back to it more. But you can see over this period we did retrace a little bit, not quite hitting, so it's not the best example right there. Sideways markets, it will twist and tie in together. You know you're in a sort of a range when it does that. If the moving averages move from the left hand side to the right hand side, you know you're in a range. So we do use moving averages as support and resistance. You can see after the price broke up through here, very slow trending, and the price came back down and tested the support, broke through the support of the 100 and more or less contacted on the 200 exponential before continuing on upwards. Now it might hit the 100, it might hit the 200 simple, might hit the 200 exponential, it might hit both as in this case. Let's have a closer look at that. So we've got a consolidation of the 200 simple and the 200 exponential moving average. If this market was short, which very probably was, this is what you'd be looking for. Is you're in a short market, you're looking for counter trends, which is short periods of a long market, and then you look out for these key reversal areas, and moving averages are one of them. Support and resistance levels are another one, or Fibonacci's. Okay, so we had a nice sell signal here with a bearish engulfing candle. Stochastic was overbought, and if you didn't get in there because it was 8 o'clock at night GMT, let's just say 2 o'clock in the morning, and then the price came back up here 9 o'clock in the morning, and you can clearly see you got an opportunity to get in at the same level, if not just a little bit higher. So we had a bearish engulfing candle from the 200 moving averages, and we had a counter trend line break right here on this candle, which was a nice confident trade. Now in this case it was a 35 pip risk, and I don't have the Bollinger Bands on it. Let's put them on and just see. Okay, so this was at the top of the Bollinger Bands, which this confluence here, we'll talk a little bit more about confluence in the advanced trading strategies. but confluence of indicators is always a great sign. You could probably draw support resistance lines in as well off the top of this candle. You can see that made a contact and a bounce from it. So this is a very confident trade. Your risk would have been 35 to 40 pips, and you can see the bottom of the Bollinger Bands, potential profit of 92. So that's twice what we were asking for in respect of your risk. So that's a good trade to take. As you can see, the price continued on down and down and down. But we're just talking about the moving averages here, so let's not get too carried away. So this is what you look for: a test of resistance, a test of resistance. It's inverted if it's support. So if the price is above it and contacts it there, now it's support, now it's support, now it becomes resistance, now it becomes resistance. Okay, so when we tie all these things in together, as well as other trading techniques, we lead ourselves to placing confident trades. Okay, but not one single indicator on its own is good enough to place a trade and feel confident about it. No indicator at all. But when you have 3 or 4 indicators all pointing you in the trend direction, it is a favourable position to take. You do need an edge in the market, and these probabilities stated above give you an edge in the market. Use the indicators with the other tools listed below, and you are using the exact same tools and techniques as the professional traders use as a trading style. As long as you have money management principles and a cool, level-headed trader psychology, you have all you need to be a winner. Okay, so you've got all the exact same tools as the professionals. We just need to implement it in the correct manner. Apply your money management, which I'll give you the access to that, and you just need to fix your psychology, how you think. We can talk a little bit more about that later as well. But that's all for these indicators just now. That's what your charts look like on the hourly. Stochastic, Bollinger Bands with a 100 period simple moving average, 200 period simple moving average, and a 200 period exponential moving average. That's all we need on our charts. It's the only indicators we use, apart from the daily chart, where it's a 20 period simple moving average to plot out our trend direction, and the 100 period Bollinger Bands just to identify ranges on a daily chart as well. Just a little chat about this 20 period moving average. You can think about some traders on certain trading styles. Let's just talk about in this Euro Yen. When this parabolic move is going up and there's signals to sell, signals to sell, signals to sell, signals to sell, right up until the top where it did actually come down. This is on a daily chart, so you can imagine the amount of sell signals that came about throughout this monthly period. And you can think about the trading styles that people do when they try to pick tops or pick bottoms. If you're trying to sell in this long market, you're going to get eaten up alive. And the same as when the price is coming down. If you're trying to pick bottoms when the price is coming down like this, you're going to get killed, you're going to blow your account balance, you're going to have to refund it and learn all over again, because this trading strategy sucks. It will kill you. So only trade with the trend direction. You can imagine if you were selling, you had no doubts that you were selling all this way, and all you had to do was go to the hourly chart and look for favourable positions all along this period, you're in a damn sight better than 90% of all the other traders down there. So we're talking about so there was the top of that move on the daily chart, so let's just mark that there. Let's just say it took a few more days before the moving average got out of the range, so you knew you were selling all the way here. Okay, let's just have a look. Okay, meanwhile people are trying to buy, 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 and the price just keeps going down. You've probably been in the same situation yourself. I used to do the same when I started out as well. I used to always believe that it would be great to catch the very, very beginning of a new trend, but trust me, it will kill you. So if all you had to do was just look for selling opportunities where the price would retrace, it's kind of hard when you've got this fast trending market, but if you were in here and you had a trailing stop and just keep going, excellent. Put your Fibonacci's in, look for your reversal levels, excuse me, not the best sell signal there, but trust me, they are in there. You can do counter trend line breaks, you can sell these opportunities, sell signal there. Another trend line break. Okay, if you got in there, you're probably only looking at about a 20 pip stop loss, and the price just crashed down. 3-4 hours, you're out of the trade. Okay, so we do not buy in short markets. Okay, but that's all for now on indicator section. I'll catch you on the next video where we'll be talking about your other tools to use, which include their Fibonacci retracements and extensions, trend lines, support and resistance lines, and candlestick formations. So hope you find this video useful, and we'll catch you on the next video. See you then. Cheers.